Welcome everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Today what we're going to do is we're going to cover maximizing income with cover calls. And this is a strategy that is arguably not the sexiest strategy. However, I would say this is probably one of the most important strategies for anyone who's utilizing options in their portfolios to really understand at the very fundamental core of the strategy, because it is actually a strategy that builds on top of all other income strategies. So it's really important to understand this one. It is also the strategy that everyone, for the most part, has the ability to do in their options trading account. So this is the strategy that really allows you to, number one, generate income without adding any additional risk in your portfolios, number one. And number two, what it does is it really allows any of you that currently have equity positions in your account to maximize the income or generate an income stream off of the existing assets that you already hold. So many of you invest in stocks because you get a dividend yield on that equity position. So that's an example of generating yield off of the assets that you own. So cover calls is another way to generate yield off of the assets that you already own, the stocks in your account. So today what we want to make sure is everyone understands this specific strategy. This is really for anyone, whether you're a brand new options trader or a very experienced options trader. This is a strategy that's suitable for basically anyone that owns stocks. Today what I'll do is I'll talk about the strategy itself, who should use it, what are the best practices for selecting expiration dates and strike prices. And the goal here is to not only understand the strategy and how to go about doing it, but more importantly, making sure that you all have a sense for how to implement cover calls on your portfolio using the tools that are available to you free of charge thanks to the TMX. So today what I'll do is I'll show everyone OptionsPlay. For those of you that have never seen OptionsPlay, we'll show you how to sign up for this free tool once we're finished with this webinar. And the OptionsPlay is really designed from the ground up to make your workflow as efficient as possible and as intuitive as possible for those of you that are looking to utilize options in your portfolio. So I'll spend about 15 to 20 minutes on the slides talking about the strategy itself and what are the methodologies, and I'll spend the second half of the webinar talking or walking you through some live examples with OptionsPlay so that you have a clear understanding as to how to implement what we're teaching you here today. So after we finish this webinar, you should be comfortable enough to start analyzing some cover call opportunities with the stocks that you have in your account. And then lastly, provide a forum so everyone can ask questions regarding how to implement these types of strategies in your account. So with that, what I want to do is just ask a quick question up front here. I just want to get a sense for the audience here. I just want to get a sense for everyone's trading experience with options. So please answer the question on your screen here just to get a sense for how many of you are relatively newer to options, how many of you have some experience, and how many of you are professionals here. Okay, so with about a third of you that have voted here, it looks like the split is pretty even. You know, about a third of you are learning, a third of you are just starting out, and a third of you have a fair amount of options trading experience, which is great. So we have a pretty diverse group of users here today. Like I said, the topic here today is really for anyone here, whether you're brand new or you're a very experienced options trader. This topic is really suitable for everyone. So let's go ahead and get started. Now, before I do that, just a quick disclaimer here. What we're going to talk about here today is purely for demonstration and educational purposes. They're not a solicitation or recommendation to trade any specific securities or options. So before I actually jump into OptionsPlay, just a little bit of housekeeping. First of all, we have an Options Education Day coming up. These are in-person seminars. We usually get about 200 to 300 people. It's a full day track on how to learn how to trade options. We have both beginner and advanced tracks that go in parallel at the same time. So for those of you that are interested, Montreal is coming up here in June 1st. For those of you that are interested in attending in person, So the early bird pricing for Montreal ends May 10th, and you can register using this link right here. I'll type it into the chat window for those of you that are interested in signing up for that. It is just $50 for the registration for Montreal that's coming up. It'll take you to this website. As you can see, the event will be on Saturday, June 1st. The early bird pricing ends May 10th for 50 Canadian dollars, and there's the full track. You can see exactly what you'll get, which speakers will be there, what option topics we'll be talking about. I'll be there myself doing 2 different tracks during that day. I'll be talking about OptionsPlay and Introduction to OptionsPlay in the morning, and then the top 2 strategies to generate income on any portfolio in that afternoon. So that's an event that's coming up. I just want to give everyone a heads up that registration comes up on June 1st. Or the registration early bird ends on May 10th, and the event is on Saturday, June 1st. And for those of you that are interested in the other cities, we do have ones coming up for Toronto, Vancouver, and Calgary in September, November, and December for those of you that are interested in the other cities. So just let everyone know that that's coming up. And just a last piece of housekeeping. For those of you that are unfamiliar with OptionsPlay, number 1, you get free access to OptionsPlay in Canada as courtesy of the Montreal Exchange. As part of that, you're going to get bi-weekly options education webinars, just like the one you're on today. Every single other week, we're going to be coming back, giving you ongoing options education for different option topics. So important piece to have for those of you that are interested in learning more. There's a free on-demand options video library that you'll have access to the previously recorded webinars, which I think is quite important for those of you that are in that learning process, since almost 2/3 of you say that you're either brand new or just starting out with learning. So that options video library is really important to help you get off the ground. And lastly, what you're going to get is weekly cover call and short put reports. This is one of the things that I'll cover here today for those of you that want to learn more about selling cover calls and want reports to understand where you can generate yield. We have these weekly reports so that you can get weekly updates as to where you can generate the most income using the strategy. And to register for all of this, you can just go to this website right here on the bottom, which I will enter into the chat window as well for you to sign up, for those of you that are not already signed up for OptionsPlay Canada. So with that, let's go ahead and get started. Number 1, what I want to first cover is, for those of you that are brand new, what is a cover call? Then I want to talk about why you should utilize cover calls. So it's really important to understand how to go about thinking why you should utilize a cover call. And I think for those of you that have equity positions, hopefully I'm able to convey this in a way that everyone understands the benefits of selling cover calls, and it really compares to something that you probably already do in your equity accounts that you don't really think of as the equivalent of selling cover calls. And that's how I want to present it today. Next, what I'll do is I'll talk about how to actually select the appropriate expiration date and strike prices for selecting a cover call. It's really important to understand some of that. Then once you understand the fundamentals of the strategy, then we move over to kind of the fun part where we show you how to actually automate some of these strategies using OptionsPlay. And this is, again, designed to help you implement as easily as possible. So it's one thing to learn it, it's another thing to implement it. So we want to make the implementation part as easy as possible. And that's really what OptionsPlay is designed to do. And we'll wrap this up by talking a little bit about the weekly cover call reports that we send out every single Monday, so you can look out for that to find better opportunities to generate income. And we'll wrap this up with exit strategies, meaning once you're in a cover call, how do you actually manage these trades as you hold on to these trades. So with that, what I want to do is I just want to do one more quick poll before we get into the cover calls. I just want to get a sense for how many of you currently sell cover calls on the stock positions in your account. So either you sell cover calls consistently, or you sell cover calls from time to time, or you do not sell cover calls at all. I just want to get a sense for the breakdown of the room here. Okay, so about, again, 2/3 of you have voted already. So Okay, very interesting. More than half of you say you have not sold a cover call before, which is good. This is really designed to really hopefully inspire you to consider taking a look at this as a strategy to generate income on your portfolio. If you're selling cover calls from time to time, or if you're selling cover calls consistently, hopefully this tool really shows you how to go about doing it more efficiently and making the time it takes for you to research selling cover calls as easy, as intuitive as possible. 20% of you say that you sell cover calls from time to time. I tend to find that selling cover calls many times is a very time-consuming project. So what we want to do is show you how we can make the research time down from a few minutes down to a few seconds. And for the 12% of you that say that you've never sold a cover call or you're not sure what a cover call is, this is designed to help educate you so you understand why this is a strategy you should deploy in your portfolio. So let's go ahead and get started here. So number one, what I want to talk about is what is a cover call. Cover calls are a simple strategy. It requires simply just any stock position that you own with at least 100 shares of. What you're going to do is you're going to sell a call option against it for income, and that combination of being long the stock and selling a call option is what we call a cover call. Now, that in itself is a very simplified understanding as to what a cover call is. However, what I want to do is talk about a little bit of a different way of thinking about cover calls, because when you own a stock, you may have a target price or a price that you think the stock will reach because that's the reason that you own the stock, because you think it'll appreciate in capital and you want to be able to profit from that and take profit on that as the stock rises. So you really should think about selling cover calls at the price that you want to take profit on any existing stock position. So selling a call on the stock position that you own creates an obligation to sell the stock at the strike price upon the expiration date. So think about any stock that you own in your account. Think about the target price that you have on it. What would you do if you had a target price on a stock? You would typically place a limit order at that target price, and you would wait for the stock to rise to that price. So selling a cover call is very similar to that, is placing an order to sell your stock at a higher price. The only difference between selling a cover call versus placing a limit order is that selling a cover call generates income. It allows you to do it over and over again, and that's the income stream that you generate by selling cover calls. Now, this strategy requires at least 100 shares because each call option you sell will deliver 100 shares of the stock that you own. And this is really a strategy that allows you to take profit as the stock rallies significantly higher. Now, the reason I have these asterisk signs up here is because that statement is only true if you follow the methodology that we're going to show you here today. So if you sell cover calls, it's not all cover calls will do this, but only certain cover calls. And that's really why we want to show you this way of selling cover calls. Now, once you sell that cover call, you really have two potential outcomes that are possible. Number one, when you sell a cover call and the stock rises above the strike price of the cover call, what happens is you sell your stock at a profit at the strike price. So think about placing a limit order on your stock to sell your stock at a higher price. Once the stock rises to the limit order, you've sold your stock, you take a profit. Same thing with the cover call. If it reaches your target price, above your target price, you sell your stock at that target price and you're able to take profit. Now, if the stock does not rise to that target price by the expiration date of the cover call, and the stock is below that strike price by the expiration date, then what you can do is you can rinse and repeat this strategy over and over again for additional income until the stock rises above to your strike price, and at that point you sell your stock at a profit. So those are the two potential outcomes that you have when you sell a cover call. Now, what I want to do is I want to walk you through some examples to give you a more concrete example as to how to think about cover calls. So for example, let's say you own 100 shares of BMO, and let's say you bought the stock at $100 and you have a target price of 110 on this particular stock. So if you bought the stock at 100 and you have a target price at 110, then one of the ways that you can monetize this is placing a limit order to sell your stock at 110 and wait for the stock to rise to 110. And once it rises to 110, you make your $10 profit and you're out of the stock. So The other option that you can do is instead of placing a limit order to sell your stock at 110, you could sell a 110 strike cover call. And for that, what you're going to do is you're going to receive a little bit of income. And that income is really what's going to change the risk-adjusted returns of your stock. And this is really what I want to show you is the difference between placing a limit order and selling a cover call and why it changes the economics of your stock position. So when you enter a limit order at 110, your risk is $100 a share because that's how much you purchased the stock for. Your reward is $10. Your potential reward is $10 a share because the difference between the 110 target and the $100 stock that you bought it at is $10 a share. And this strategy is profitable as long as BMO stays above $100 a share. Now, this strategy gives you exposure until BMO rises to that 110. Until BMO rises to 110, you will maintain exposure in BMO. On the other hand, if you sold a 110 call, which again gives you the obligation to sell your stock at 110 just like a limit order, however, now as you can see, your risk changes a little bit because you received $2 for selling that cover call, now your risk instead of $100 is only $98 a share. It's not a huge difference, but it is certainly a small downside protection that you're going to get by selling cover calls. And what that does is it not only reduces your risk, but it also increases your potential reward. And this is the risk-adjusted improvement that you're going to get by selling cover calls. So now your potential reward on BMO stock, instead of being $10 a share, is now $12 a share because the difference between 110, the target price that you have on the cover call, versus your new cost basis on the stock, which is now instead of $100, only $98. Now your reward is $12 a share. So now you start skewing your stock. You're now minimizing risk and increasing your rewards. And this strategy is now profitable as long as BMO stays above $98. So even if BMO drops a little, you're still actually profitable on this overall position, unlike if you just place a limit order. And lastly, when you sell a cover call, you maintain exposure until the expiration date. And if it doesn't go above your strike price 110, you can repeat this cover call and keep generating an income stream. So if you collect $2 this couple of months, and let's say by July the stock doesn't rise to 110, you can sell another cover call for another $2 and further decrease your risk and further increase your potential rewards. And that's really the income stream that you're going to get by selling cover calls. And this is available on stocks that you currently own in your account. So if you have stocks in your account, this is one way to generate yield off of that stock in your account that not only changes the economics of your stock position, but also generates an income stream while you hang on to that stock position. So with that, some of the benefits for selling cover calls is the number one is allowing you to take profit on the stocks that you own while generating the income stream while you wait for that stock to take profit. So you own the stocks because you think it's going to rise. So why not generate a stream of income on top of that while you wait for the stocks to reach that target price? That's really the goal of selling cover calls. And by doing this, by creating this income stream, you're going to lower the volatility and the net cost basis of your stock. And the best part of all is that it's used on the existing stocks in your portfolio. It doesn't require you to buy any new stocks. You can just use the existing stocks in your portfolio to generate income. Now, there are some limitations. So number one, it does require patience because the stock must rise above the expiration date, must expire above the strike price at the expiration date. So this is not something that you necessarily have, unlike a limit order that gets triggered immediately. The stock hits above that target price. On a cover call, it only really executes when it rises above that strike price upon expiration. So that's something to consider, is that if you really need to get out of the stock as quickly as possible, you might want to place a limit order instead. This does require at least 100 shares of that stock. So if you have any stocks that you own less than 100 shares of, this is not a strategy that you can implement. And lastly, you risk selling your stock at the strike price. So this is something that you have to be comfortable with as to being able to offload your stock at that strike price that you sell your cover call at. So those are some of the benefits and limitations of selling cover calls. So with that, what I want to do is I want to talk about how do you actually go about selecting an expiration date and strike price. So when it comes to expiration dates, it really comes down to how often you trade. So for active investors, typically you're going to start on the shorter end of the curve, So anywhere from 21 to 49 days out is usually a good starting point for active traders, so 3 to 7 weeks out. For long-term buy and hold investors where you're not actively trading in your account, you might want to choose longer dated options simply because you don't have the time to look at your portfolio on a more frequent basis. You would choose longer dated options 3 to 6 months out. And for many of you, you might fall somewhere in between that, where you might want to choose monthly options anywhere from about a month and a half to about 3 months out. Now, what I want to talk about is what do you actually expect in income based on these different types of expiration dates? So on the shorter end of the curve, you're going to get a lot more certainty. What I mean by that is if you sell a 4-week call, chances are you have a pretty good amount of visibility as to what's going to happen between now and 4 weeks from now, whether there's earnings coming up, a dividend, or even things like product or news announcements. You probably have a good sense for what may happen in the next 3 to 4 weeks. Versus if you sell a 3-month or 4-month option, there's a lot less visibility into what's going to happen. So you have a lot less certainty. So the further out in time you go, you're going to get more income versus a shorter amount of time that you go, you're going to get less income. So the question becomes, which expiration dates should you choose? And many times users will tend to lean more towards the longer end of the curve because you're going to get more income. However, based on all of our back testing, one of the things that we discovered is that it's much better be on the shorter end of the curve here on the active investor side, because what you're going to be able to do is you're going to sell cover calls much more frequently. And what you're going to do is you're generally going to be able to make up more income by selling shorter dated options more frequently than you're able to do longer dated options, even though they have more income. And the reason for this is a few different things. Number one, you want to generally avoid selling cover calls going into earnings. Now, when you sell a shorter dated option, you have the ability to be very nimble and avoid the cover calls when there's earnings coming up. So if you sell calls that are 1 month from expiration, you can do that 12 times a year. So roughly 25% of the cover calls that you sell have this earnings cycle built into it. You can actually avoid those and still sell cover calls the other 8 months out of the year. If let's say you sell a long dated option, you sell a 3-month option, you can only do that 4 times a year, which means that you're really not able to ever avoid selling cover calls. So you always have this large risk factor built into selling cover calls going into earnings. So there's really no way to avoid that. So that's why whenever you have the choice between 2 options, whether one's shorter dated and one's longer dated, you're better off skewing towards that shorter dated option whenever you're selling options as a general rule of thumb. And this applies to other strategies as well, whether you're selling cover calls, cash secured puts, or even more advanced strategies like credit spreads. This rule of thumb of leaning more towards the shorter end of the curve applies pretty much to all strategies. The second reason why it makes more sense to sell short-dated cover calls is the fact that the premium that you receive is not linear to the amount of time that you go out. Meaning, we said that the longer time you go out, the more income that you're going to get. However, what we find is that when you sell a 1-month call, let's say you receive $1 in premium for that 1-month call, when you go out to a 3-month call, you're not going to receive $3 for it. You're actually going to roughly receive only $2 for it. And this is really why it makes more sense to sell shorter dated options more frequently, because you're at the end of the year, it's going to add up to more income than if you do a 3-month call less frequently. So because of this reason, we tend to find that whenever you're selling any type of strategy, it's better to lean more towards the shorter end of the curve. Now, this doesn't necessarily mean that you have to sell these very short dated options, just that if you have the selection maybe between a 30-day option and a 50-day option, that you're better off skewing towards that 30-day option whenever you have the choice between 2 different expiration dates. And this is really a more of an illustrative purpose of what we're explaining. So this is a time decay curve of an option. So the value of an option actually decays as you approach options expiration. And as you can see, this curve is not linear. It actually accelerates as it gets closer and closer to zero, or closer and closer to expiration. Now, because you're selling an option, this time decay is actually working in your favor. So because you're selling an option, what you actually want this curve to decay is as fast as possible. So as you can see, you can maximize time decay, or theta, in the weekly options, because that's when the options are going to decay the fastest. So you're actually going to receive roughly the same amount of income in the last month before expiration as you do the previous 2 months. So what that means is that if you sell a 3-month option for $2, you're only going to collect roughly $1 of that income in the first couple of months, and then you're going to receive the last dollar in just the last month. So that's why you want to focus your attention more so on selling shorter dated options, because that's when you're going to get the most amount of income as quickly as possible. So hopefully that helps everyone understand when you're selling options why you want to lean towards the shorter end of the expiration date cycles whenever you're selling options. Now, when it comes to strike prices, this is really where it depends on your risk tolerance. And when you sell cover calls, think about cover calls as a target price that you have on your stock. So if you're very conservative and you have a very high target price, these are relatively higher strikes that give your stock a lot more upside before the stock is taken out or before you sell your stock at a profit. And for that, what you're going to do is you're going to receive less income. For those of you that are very aggressive and you want to sell your stocks relatively quickly, you're going to sell relatively lower strikes, so strikes that are closer to the current price of the stock. This is going to provide a lot less upside for your stock to grow before the stock gets called away. And in exchange, what you're going to get is more income. So this is really how you would select your target prices based on whether you're conservative and you think the stock's going to continue going quite a bit, or you're aggressive and you think the stock, you want to get taken out relatively quickly. So what we also did is we tested different strike prices to get a sense for where are you going to get the best income for your positions. And the answer is on the shorter end of the spectrum, on the conservative end of the spectrum, is the answer as to where you're going to get some of the best returns from selling cover calls. And this is really because selling cover calls is what we consider a negative risk to reward ratio. Negative risk to reward ratio means that the income that you receive on a cover call is fixed. There's a limited amount of income that you can receive off of these strategies, but the risk that you have of the stock going above your strike price is unlimited, meaning the stock can go $10, $20, $100 above your strike price. And when it goes above that strike price, you lose out on all of that. So think about a limit order. If you place a limit order at 110 and the stock rises up to 150, you still sell your stock at 110, which means that you've lost out on the $40 above that, right? So the amount of money that you can lose out on is unlimited, but the amount of income that you receive is fixed. So this is why we have a negative risk reward ratio. So the lost opportunity is limited. So what you want to do is actually, you want to give your stock as much upside as possible. And that's more important than the extra 20 or 30 cents that you might get from selling a very a cover call that's very close to the current price that may have more income. Now, how do you actually go about selecting conservative, optimal, and strike prices? And the answer is you want to use probability. So a lot of you ask, what does 90% POW, 80% POW, and 70% POW means? This is really a probability-based approach to selecting your strike prices. So a strike price with a 90% POW is a strike price that has a 90% chance of you keeping the income on that trade and the stock, and only about a 10% chance that the stock's going to get called away. So we use delta on an option chain to determine what is the probability of a stock reaching a specific price. So a 10 delta strike price has a 90% chance that the stock will not reach that price. So this is a price that's relatively far away from the current price. There's only a 10% chance of that stock hitting that price. A 20 delta is slightly lower strike price, though now an 80% chance that the stock will not hit that strike price. And an aggressive is a 30 delta, so only about a 70% chance that that stock will not hit that particular price. So this is really how you should think about selling cover calls, is how far does the stock need to move in order for it to reach my target price? The higher the target price, the less likely it's going to reach there. And that's how you go about selecting your strike prices when you're selling cover calls. So once you've done all that work of selecting relatively short-dated cover calls and then selecting the appropriate strike price based on perhaps where your target price on the underlying stock is, once you do all that work, many times you might pull up the option chain. Sometimes that cover call pays you 5 cents in income, sometimes pays you $5 in income. How do you know what's enough income? And the answer is very, very simple. You want to compare the cover call yield to the dividend yield of the stock. And the goal here is very simple, is you want to beat the dividend yield with the cover call. So for those of you that are asking, how do I know what the cover call yield is? Don't worry, OptionsPlay actually does the calculations for you. And all you have to do is just compare the cover call yield to the dividend yield, which I'll show you here in 1 second, and you'll instantly be able to quickly see, am I getting enough income for the trade? So, and the reason that you want to beat the dividend yield is because if the stock gets called away, you lose out on the dividend. So you want to make sure that the yield that you're getting on that cover call at least beats the dividend. So it makes sense for you to generate those types of yields because it's going to put you at risk of losing your stock. So you have 3 scenarios here. You have a stock with a 3% cover call on a stock that pays a 1% dividend. Those are the types of scenarios that you're looking for where you're greatly increasing your yield from 1% to roughly 4% by selling cover calls. A bare minimum is a stock that pays a 3% dividend and you get a cover call that pays 3%. That's the type of bare minimum that you're looking for. And lastly, if you have a stock that pays a 3% dividend and you're looking at a cover call that only pays a 1% yield, those are the types of strategies that you want to avoid because you're just simply not getting enough yield on the cover call to risk losing that 3% dividend on that stock. So that's how you go about quickly selecting whether or not you're getting enough income. So with that, I just want to leave you with a few tips before we jump over to OptionsPlay and show you some of the reports that we have to make this process as easy as possible. So number 1, it's really important to sell cover calls immediately after you acquire shares. So for those of you that answered on the poll that you trade, the second question here, there's quite a few of you that say that you sell cover calls from time to time, and many of you say that you do not sell cover calls. So for those of you that sell from time to time, this is really a strategy that you don't want to just do here and there. It's a strategy that you want to do consistently, and you want to do it consistently right after you acquire the shares, because the benefit of cover calls really comes as you start doing it immediately. Because if you buy a stock and you're down 10, 20, 30% on the stock, then you consider selling cover calls, sometimes that's a little too late. So it's a strategy that you have to start immediately once you acquire the shares. Now, again, just to reiterate, selling shorter dated options maximize time decay. So whenever you're choosing an expiration date, you always want to lean towards the shorter end of the curve. You want to sell strike prices that have relatively low probability of assignment. Usually 15 to 25% chance is usually a good starting point for selling cover calls because, again, you own your stocks because you think it's going to appreciate in capital. Don't limit that by selling very aggressive cover calls for an extra 20, 30 cents in income. It's not worth giving up $5 or $10 in upside to collect an extra 10, 20 cents. And lastly, avoid selling cover calls going into earnings. So if you see an earnings coming up, try not to sell cover calls going into it because chances are you might lose out on that big push on that stock as it increases on earnings because you've tried to maximize in another 20, 30 cents in income. It's not worth that 20, 30 cents. So avoid selling cover calls going into earnings. So what I want to do is I want to talk a little bit about some exit strategies. So when you sell a cover call, there's really 3 scenarios you'll find yourself across. Number 1, the stock shoots up higher. Number 2, the stock moves sideways. Lastly, the stock moves lower. So those are the 3 scenarios that you'll find yourself in. And what I want to talk you through is how to handle each one. So the first one I think is where most people tend to panic a little when the stock rises after you sell a cover call above that strike price. In my opinion, this is really a good thing because that means that you've made money on the stock position that you bought. Like you bought the stock because you think it's going to rise. So if it rises above your strike price, that's a good thing. But I tend to see that a lot of people that sell cover calls panic when this happens because, they see this unrealized loss on the short call that they've sold, even though it's offset by the gains in the long stock. This is really where I see people panic. And the best advice that I have for you is do not panic. You want to hold on to these cover calls until expiration or very close to expiration. And if you need to roll those cover calls, what that means is buy back the call that you've sold and sell another cover call because perhaps you think the stock's going to continue going higher and you're not ready to sell the stock. This gives you an opportunity to continue selling cover calls. And what you can do is you can do that only in the last week before expiration. So if you sell a cover call and it still have 4 weeks left and the stock rises above your strike price, don't panic. Just hold on to the cover call. Wait till the last week before expiration. Then at that time, consider what you want to do next, whether that's let the stock gets called away and take profit, or you want to buy back that call and sell another one so that you don't sell the stock immediately. Second scenario, if the stock moves sideways, this is really where you want to hold your positions until expiration. You don't want to do anything in this particular case. You want to let that cover call expire worthless, and you want to do it all over again. This is really where you generate an income stream. And lastly, if the stock does plummet after you sell a cover call, this is really where it makes sense to roll your position early. That means buy back the call that you sold and sell another one. And the rule of thumb here is that if you can buy back a call that you sold at 20% of the original premium that you sold it at, that's a good time to consider buying back a call early. So what that means is that if you sell a cover call for $1 and a week later you can buy back that call for 20 cents, that's when you want to take profit on the 80 cents of income that you've made and sell another cover call immediately. So you don't have to wait all the way to expiration to make those extra 20 cents. You should take profit on the 80 cents and start selling another cover call immediately. So those are the three scenarios that you'll generally find yourself across when you're selling cover calls, and how to go about handling each one. So with that, what I want to do is I want to go over a few different things. Number one, what I want to do is I want to show you the cover call and short put report that we have that's available to everyone. For those of you that are signed up for OptionsPlay, you'll get an email every Monday at around 10:30 a.m. Eastern, which gives you both a cover call report as well as short put reports. That's actually the next webinar we're going to be doing in about 2 weeks, is selling short puts, which is a way to actually enter the stock positions that you own. Very underutilized strategy. I hope I get to see you guys on the next webinar. So with that, what I want to do is I want to jump over to OptionsPlay. I want to show you how this platform is designed to make this process of selecting everything that we're showing you here today and pointing you to the right starting points as easy as possible. So what I'm going to do is I'm going to jump over to OptionsPlay. For those of you that have not signed up, we'll show you the link on how to sign up in a few minutes if you didn't catch it at the very beginning of the webinar. This is a tool that's available to everyone here in Canada free of charge. You have trade ideas and watch lists here on the left-hand side of your screen. In the middle is our security analysis panel, and on the right-hand side is trading and income. This is designed to help you generate income very quickly on all the stocks that you own in your account, and that's what I want to walk you through here today. So first of all, what I want to do is I want to show you how to set up a watch list. You can easily click on Menu, create a new watch list. That allows you to put in all the symbols that you own in your account. And what that allows you to do is simply click on any symbol and it populates the rest of the screen. So on the right-hand side of the screen, there are two options that you have. You can click on Trade. So for those of you that are interested in trading strategies and speculating on bullish and bearish ideas, that's what the trade panel is for. Today, what we're going to focus our attention on is the income panel, which gives you two options. Either you own shares of the stock, which if you're selling a cover call, you need to own shares of that stock. You would click on yes, and it will show you a cover call to sell with the starting point. Or if you click on no, it'll give you the cash secured put. That's what we're going to cover on our next webinar. So today we're going to focus our attention on cover calls. So here I have Royal Bank of Canada. This is trading at 106.32. Now we talked about selling short-dated options and selecting a strike price based on probability of expiring worthless. So using delta to select a strike price. So what this does is it actually does all of the work for you. Now, what we do is we choose cover calls based on your personalized settings. So when you click on the income tab, there's a button here at the bottom that says income settings. You can choose from short, medium, or long-term cover calls, and you can select conservative, optimal, or aggressive. So this is really where you can choose your time frames and your risk tolerance on the stocks that you own. And once you select those preferences, which for me are short-term because I'm fairly active, and risk tolerance, I choose optimal because I'm not too conservative and I'm not too aggressive. So what I do is I save this as default, and for any stock that I click on, it immediately tells me which starting points to use for selling cover calls. Now, for any of you that have ever learned how to trade options, you've probably looked at a page that looks like this, right? Now, there's nothing wrong with this page. However, what we tend to find is that most users get a little lost as to where to start, right? What expiration date do you choose? What strike price do you choose? Even if you knew that, meaning even if you learn from our webinar today how to go about selecting expiration dates and strike prices, you'll find that once you made your selection, all you have here is just a bid and an ask price. So how do you know how much yield are you getting? How do you know how much income are you actually going to receive from this? It's not easy to figure that out. Chances are you're going to take the data from the screen and you're still going to have to plug it into some kind of calculator to get that type of information. With OptionsPlay, we give you all the information at your fingertips. So not only do we select the expiration date and strike price for you based on your settings, we also tell you the yield of the cover call. So here, Bank of Montreal is trading at 105.5. This is telling me to sell the May 31st, which is 24 days from expiration. That's in that shorter end of the curve that I'm looking for. And it's telling me to sell a 108.5 cover call. And it tells me the probability of expiring worthless on that is about 80%. So there's only about a 20% chance the Bank of Montreal is going to rally to about 108.5 by that May 31st expiration date. And that's why we chose the 108.5 cover calls, because on the optimal track, what I want to choose is strike prices that have roughly about a 20 delta, or an 80% chance of that call expiring worthless, or an 80% chance that I get to keep the income. So this is why it selects the May 31st 108.5 cover call. It tells me that this cover call generates a 3.75% annualized yield on a stock that pays roughly about a 3.75% dividend yield. So we talked about figuring out, do we have enough income? In this particular case, this is just enough income for me to take on this type of risk. And if I do this strategy, I bring my total 12-month yield on this stock from 3.75 to 7.5. So I've effectively doubled my yield by adding cover calls to my BMO position. So if you own BMO stock, you get paid a pretty nice dividend, 3 3.75 dividend, which I think is a pretty hefty dividend right now. But if you add cover calls on top of that, you can double that to about 7.5%. This is really why most of you should really consider selling cover calls, because you own the stock, you're getting the capital appreciation, you're getting the dividends. Why not add an income stream on top of that? That's going to help pay for any downside protection on the particular stock. So this is really why this is a strategy for those of you that own stocks that you should really think about. Now, the problem for most people is that when you use a page that looks like this, it takes a lot of time to figure out what expiration date and what strike price to start. And then you have to do this manually every single time an option expires, and you have to calculate these yields manually. We do all of that work for you. All you have to do is click on a symbol. So let's say we're looking at TD, which is trading at 75. This instantly tells me that if I own TD, I should sell the May 31st 77.5 cover call, which also has roughly about a 77% chance of expiring worthless, very close to that 80% target that I'm looking for. And it tells me that's a 5.44% yield on a stock that pays a 3.8% dividend yield. So this increases my TD yield from 3.8% to about 9.3%. So as you can see, this is really increasing my yield on the stocks that I own in my portfolio. So this tells me that as long as the stock stays below 77.5 on May 31st, I'm going to collect the $27 in income for every 100 shares. And let's say I own 500 shares of TD. So now I'm selling 5 contracts, so now my income is $135 over the next 24 days. And this is the income stream that you're going to be able to get off of your stocks in your account. And we made this platform as easy as possible for you to go through all the stocks that you own in your account and instantly be able to very quickly see Bank of Nova Scotia trading at 72 right now, paying a very hefty 4.7% dividend yield, but selling a cover call on top of that, selling the May 31st 75 cover calls, generates $21 in income, which is 4.3% annualized return, which brings my total yield to about a little over 9%. So if you own Bank of Nova Scotia, you get a pretty hefty 4.7% dividend. If you add a cover call on top of that, you're looking at closer to about 9%. So you're almost doubling your yield by selling cover calls on Bank of Nova Scotia. And this is really designed so that you can click on any symbol without having to go through pages and pages of options chains like this, instantly know where to start. So on CNR trading at 123.94, selling that June 21st 130 cover calls, generates about 3.47% annualized return on a stock that pays a 1.7% yield. So CNR does not pay a very large yield, so you're going to be able to increase your yield from 1.7% to about 5% by selling cover calls on CNR. Now, as you can see, what this does is it makes this process as easy as possible for you to very quickly find opportunities to sell cover calls on the stocks that you own without having to spend hours and hours to research it. However, what you'll find is that for those of you that have experience selling cover calls, you'll notice that sometimes you go through all the steps that we're laying this out for you today, and you might find that you do all that work and then you realize there's not enough income, or maybe the strike prices or expiration dates just don't match up. So what this tool not only does is it tells you when there's an opportunity, it also tells you when there's no opportunities. And this is also designed to save you time. So Barrick's Gold trading at 17.12, as you can see, I get a very different message. This is telling me that OptionsPlay could not find a short-term optimal call, which is my personal preferences. It's telling me it found me the next best alternative, which is short-term aggressive. So in this particular case, what this tells me is that if I'm trying to generate income on Barrick's Gold, this is probably not something that I want to do, because I have to sell a May 31st 18 cover call, which generates $19 in income, which does give me a nice annualized return. However, as you can see, this is pretty aggressive, meaning there's only a 75% chance that this call is going to expire worthless. So it's outside of the range that I'm looking for. So this is really designed to give you a sense for how to go about doing this. And this is really designed to make your process as easy as possible. And lastly, for those of you that are interested in selling cover calls, we do have a report that also gives you a sense for which stocks has the highest yields. So this is a report that's emailed to everyone Monday morning. And as you can see, what it shows you is the symbol, the expiration date, the strike price, the current price of that option, and the implied volatility with the raw return and the annualized return telling you how much yield you're going to receive. So many of you probably own a lot of these cannabis stocks, which probably doesn't surprise you that it's at the top of the list, because these are very volatile stocks. These are the stocks you generate very high amounts of income. And these are ways to potentially take profit on these very volatile stocks and at the same time generate some pretty astronomical yields on these types of stocks. And these are really some of the stocks that you're going to see some of the most action on, and some of the best yields is selling stocks on some of these cannabis stocks. So keep that in mind when you're thinking about generating covered calls on the stocks that you own. And this is really designed so that you have as many tools as possible at your disposal to instantly be able to very quickly click on a symbol and know whether there's an opportunity to generate income or not. So here on Manulife, this is not something that you can probably generate much income for, so you can just move on to the next stock. So on BCE, there is a cover call. On TRP, TransCanada, there is a cover call. On Enbridge, let's see if there's one. So on Enbridge, there isn't one. So this is telling me very, very quickly, I can go through a list of 20, 30, 40 stocks and instantly know where there's a cover call opportunity and where there is not. And lastly, the cover call report is designed to allow you also see across the entire spectrum where you have opportunities to generate the most yield from cover calls. Maybe that might also, maybe if you're thinking about buying some equivalent stocks, this might be a way to determine whether you should, buy the stocks of one particular cannabis stock versus another, is the amount of yield that you can generate off of it. So this is all designed to make your investment decisions on the underlying stock as easy as possible as well. So with that, hopefully what this does is it shows you the sense for how OptionsPlay is designed to quickly make your options trading experience as easy as possible. And again, for those of you that are interested in learning more about this, you can register for OptionsPlay at optionsplay.com/TMX, which I just entered into the chat window again. So with that, I want to thank everyone for taking the time out here this afternoon. I apologize for the audio issues we had at the beginning. I will make sure that we scrub that out and redo this for the recording. So for those of you that are interested in the recording, that recording will go out in about 40 minutes after we finish here today, along with the slides. So if you have questions about anything, please, you can type them into the chat window and I'll answer as many questions as I have time for. But you can also review this recording afterwards at your own pace especially for many of you that said that you're relatively new to options. So you may want to review what we're talking about here today on the recording with the slides at your own pace. So again, thank you so much for taking the time out here this afternoon. If you have any questions, please type them into the chat window and I'll answer as many questions as I have time for. So Ed is asking a great question. Ed saying, I've avoided cover calls because I don't know what to do if the underlying stock falls through the floor. So Ed, I don't know what cover calls has to do with that, because if the stock falls through the floor, whether you sell a cover call or not, you are in the same position. And I would argue that you're in a better position if you have sold cover calls and the stock falls through the floor, because you've generated some income, which means that you've lowered the cost basis of your stock. So instead of risking $100 a share, if the stock falls through the floor, you're now risking only $98 a share. And that's if you only sold one cover call. If you sold multiple cover calls, you can reduce your cost basis. So I would argue that, especially if you're concerned about the stock falling through the floor, you should definitely be selling cover calls, because that reduces your risk and it increases your chances of owning that stock at a higher price. But like I said, whether you sell cover calls or not doesn't impact the fact that the stock may fall through the floor. But if you do sell cover calls, you may be in a better position when the stock does fall through the floor. So I hope that answers your question, Ed. Azim, these details are well presented, good slides and points. Deciding to select expiration dates, very good. Thank you, Azim. I really appreciate that. Renee and Michael asked about probability of expiring worthless on one of these slides here. Hopefully I answered your questions during the webinar as to what POW means, is the probability of expiring worthless. Francisco is asking, what about commissions in Canada? TD and RBC, I know, charge $10 Canadian plus $1.25 for each option contract with 43 Canadian assignment fee. Any idea of broker with more competitive commissions in Canada? So I'm unfortunately not a Canadian resident, so I cannot open a Canadian options trading account. So I'm not familiar unfortunately, on commission schedules. I don't know if anyone else has anything to offer in that. Please type them into the chat window if anyone has some thoughts as to better commission models in Canada for selling cover calls. You know, this is really part of what we're trying to communicate here, is not only us providing education to you, but giving everyone else a forum to share ideas and share information across other option strategies or option brokerage firms. So if anyone has a brokerage firm in Canada that you like the commission models for, please feel free to type them in the chat window. I'm happy to share that with everyone. Trevor's asking, is the cover call report relative to Canadian stocks? Yes, the cover call report is only for Canadian stocks. Claude, thanks, great presentation. Thank you so much, I really appreciate it. Azim, what happens if you have a stop loss and gets triggered? Well, then that happens with any other stop loss. You get stopped out of the trade. Azim, I'm not sure if you mean the stop loss on the option or stop loss on the stock position, so please clarify if you don't mind. Roger and PD, thank you so much. I really appreciate it. Bradley's asking, are most options traded as American or European options, and how would that change anything in this webinar? So all Canadian equity options are American style options, which means they can be exercised at any time. So it doesn't necessarily change anything, because we are assuming that all options are American, so which means that they can be triggered at any time. So when an option strategy, or when a cover call is exercised early, which you unfortunately cannot control as a seller, what it does is it immediately triggers you selling your stock at a higher price. In my opinion, that depends on how much you want to sell your stock. So if you want to sell your stock, that's a good thing, because now you've sold your stock prior to expiration at the price that you wanted to sell your stock. So Bradley, I don't know that it changes anything. It's just a matter of preference as to, you know, how much you want to sell your stock. Renee, see you in Montreal. Thank you so much. I will see you there. Kenneth, thank you so much. I really appreciate it. Alan, can we get the Monday list on the OptionsPlay site? So it's a separate report, which is why we email it out to everyone on Monday. So if you've registered for OptionsPlay, you'll get the report every Monday. Michael, you said you can automate. When I say automate, I mean that we automate the process of selecting cover calls for you. So you can type in any stock and instantly see which cover call to sell. You don't have to pull up an option chain, figure out which expiration date, which strike price. You have all the information to be able to click on trade and enter this immediately into your broker's platform without having to do any additional work. You just simply click on the symbol and we'll tell you where to start, and you can simply click on the trade button to enter this trade into your broker's platform. Ash is saying, which are better suited for cover calls, individual stocks or ETFs? So both are equally suited for cover calls. However, you'll generally find that you're going to get more income on individual stocks than you will get on an ETF. Steve is saying, why aren't you going to cover automating cover calls? So this is as automated as we can do because we are not allowed to trade your actual account for you. This is the most automated we can possibly do for your account. Wallace is saying, does OptionsPlay support US stocks? Yes, if you are interested in doing this for US stocks, you can go to optionsplay.com and sign up for a free trial. We offer everything for US stocks as well. On stocks like Hexo, can you also protect for downside and cover at the same time? So for any stock, you can always protect for downside as well. So let's see. So for any stock, what you can always do is you can sell a cover call and use the premium that you receive that to buy a put. But on the very high volatile stocks like that are very hard to borrow, you're going to find that it's going to be much more expensive for you to buy puts than the calls that you receive. So yes, you can, but it's not going to be able to pay for all the downside protection that you need. Do you have to sell cover call if sells stock? Michael, I'm not sure what you mean by that question. If you don't mind clarifying, I'm happy to answer that question. Bruno, can you please elaborate on the risk of being assigned? Worst case scenario, you have to sell the stocks that you own. Yes, so that's exactly what being assigned means, is you sell the stock that you own. So the probability of expiring worthless is just telling you what is the probability of that happening, or the probability that you keep your income. So if you see the probability of expiring worthless is 80%, that means you have about a 20% chance that you will get assigned and you will lose your stock. How do you buy back the call? Great question. That's a question that you can ask your broker because each broker is a little different, but you can simply enter an order. So when you enter this order, this is a sell to open. When you're ready to close it, this would be a buy to close. So you should call your broker and have them walk you through that type of that order first, because it's a simple order. You're just flipping sell to open to buy to close. Ash is saying CIBC charges $6.95 plus $1.25 a contract for those of you that are interested. Peter is saying, what happens if after selling a cover call, the stock becomes deep in the money a few weeks before expiration date? So that's what I covered here before. If that does happen, what you want to do is you want to hold on to that position, and you don't want to panic. You don't want to do anything until the last week before expiration. And only in that last week do you want to decide whether you want to roll that cover call or you just want to let the stock get called away at that time. Looks like a few people are saying interactive brokers is cheaper, but be concerned about the customer support levels. How can I use option analysis to filter by implied volatility? So that's one of the reasons that we provided this report, is that you can filter by implied volatility. You can sort this by implied volatility to see which stocks have the highest implied volatility. Azim, stop loss on stock. So I guess the question is, if you have stop loss on your stock, do you have to buy back the call? Yes. So if you have a stop loss on the stock, then chances are your brokerage firm will immediately buy back the call for you. So this varies from broker to broker because some brokers may not allow you to have that naked call out there. So if you're if you have a stop loss on the stock, yes, you're going to have to buy back the call or close that call once that stop loss is triggered. Rose, thank you so much. I really appreciate it. Mark is asking about managing multiple cover call positions for as many names, like 10 different names. Any account management software helping on earnings date, rolling management, all the tedious work? So Mark, one of the recommendations that I've gotten from some users that find managing cover calls tedious is to sell monthly cover calls, because then you only really have to worry about it once a month. So if you don't want to sell weekly cover calls and have to worry about it every single Friday, one way to avoid that is just sell 1 month calls so that you only have to look at it really once a month. Rose is saying, easy to understand, pace was perfect. Thank you so much, Rose. Francisco, same thing. Thank you so much, I really appreciate it. Edward, thank you so much. Can we see US options on OptionsPlay? Yes, you would have to sign up at optionsplay.com for a free trial at OptionsPlay to use US version of OptionsPlay. Looks like Peter saying that I found Questrade to be the best in terms of option commissions for multi-leg, and they charge basic commissions $9.99 instead of multi-basic commissions for multi-leg trading. So it seems like a few different CIBC and Questrade and interactive brokers have been thrown out as potential alternatives to TD Ameritrade, or TD Canada rather. Serge is asking, what do you think about selling cover calls with expirations a few days after earnings and rolling prior to earnings in order to use IV? See you at the Montreal TMX options. So Serge, thank you so much. I will see you there. But absolutely, selling cover calls right after earnings and rolling prior to earnings is certainly a strategy that I think is exactly what we're trying to say, is don't sell earnings going into earnings, but once the earnings is done, it's a time to consider selling a cover call. So that's exactly what we suggest that you should do. I might be getting ahead to the next webinar, but can it be argued that simply selling a put option could achieve similar results and free up capital instead of using capital to own the stock right away? Absolutely. This is actually something that I plan on talking about on our Options Education Day, is the top 2 strategies to generate income on any portfolio. What I'm planning on talking about is how you should sell puts to enter your stock positions, and once you're in those stock positions, sell cover calls on top of it to exit your stock position. So you should really be utilizing options on both sides of getting in and out of your option positions to maximize income. So that's actually what I'm going to be covering in Montreal. But for those of you that cannot come to us in Montreal, that is also one of the future webinar topics that I'll be talking about here as well. So Bradley, thank you for bringing that up. Edward, my broker requires 25K deposit to trade cash married puts or cash secured puts. So again, I bring this question out to the group. Does anyone else have similar experiences at other Canadian brokers where you're required to put up a significant amount of capital to sell cash secured puts? And if not, what brokerage firms you might recommend? What do you think about having long call instead of stocks? So certainly another option topic that I plan on covering is how do you replace stock positions with long calls? Now, I will say that if you're going to try to replace a stock position with a long call, you better use long dated options, meaning options that are relatively, at least about 9 months, if not a year out. So I would be looking at January or March of next year is the type of options that I would be looking at. And I would be looking at in the money calls. So calls that are relatively deep in the money. Those are the only calls that are suitable for replacing a stock position. Are there any brokerage firms that could have direct API to this platform like in the US? So there are a few. If you have questions, you can send me an email at info@optionsplay.com for those of you that trade US securities. Also, Questrade charges $24.95 for assignment, while other charges $40. So it looks like Questrade's a little cheaper on the assignment. What do you mean by rolling the call? Rolling the call is very simple. It just means buying back the call that you sold and selling another call in one order. So if you sold a call to get out of it, you would buy it back. And what you want to do is you want to sell another call once you've bought it back. So the process of buying back that call and selling a new one in a single order is what we call rolling that call. For strategies like short put, spreads, etc., do you need higher levels of options privilege by the broker? Yes. Generally speaking, all other option strategies besides cover calls require a higher option level privilege by your broker. Trevor's asking, is open interest a concern? That's a really good question. So one of the question is open interest a concern? So generally speaking, open interest is not really a concern. And the reason I say this is because look at BMO, right? BMO is a very, very liquid stock. But notice how people tend to trade round numbers. So as you can see, there's a lot of open interest at 107 and virtually no open interest at 108.5. Now, liquidity is a factor of the underlying stock, not of the option. So the 107s is not any more or less liquid than the 108s. Yet the 108s show zero open interest in volume, and the 107s show a huge amount of open interest in volume. So keep in mind that open interest is not really a good gauge for liquidity. The spread between the bid and the ask price is usually a much better gauge for liquidity. So keep that in mind. Edward saying, I like Questrade too. Michael saying, if sell underlying stock, do you have to buy back the call option? Yes. So if you sell the underlying stock, you're going to have to close or buy back the call option that you sell. Ash is saying CIBC sends you tax forms. I don't think Questrade does. So I don't particularly have a comment on that. Alan, thank you so much. I'll see you in Montreal. Can't wait. Thank you so much. I'll see you there, Alan. Azim is saying, great. Can you explain high IV and what that and why and is that what is preferred? So high IV, it's not a matter of preference. High IV just means that the market is expecting the stock to be very volatile. Low IV means that the market expects the stock to not be very volatile. So it's just an expression of how volatile the market expects the stock to be in the future. It's not better or worse for anything, just that the higher the IV, the more premium you're going to receive, but it also means more risk. So it's not better or worse. It's just a measure of how volatile the market expects the stock to be in the future. Edward saying, I came in late. Can I get a copy? Absolutely. Everyone's going to get a copy of the webinar, both the recording and the slides, in about 30 minutes after we finish here today. Raymond, thank you so much. I really appreciate you taking the time to participate every single week. I hope you find this very helpful as normal. Norm is saying, actually buying a longer dated 30 delta to replace stock gives less risk and actually cheaper than in the money because you will get more shares for the same dollar and gamma increases faster as stock goes up. So Norm, I'm happy to debate the difference between buying 230 deltas versus 160 delta. I understand what you're saying from that perspective. But the problem with the 30 deltas is the speed at which they decay is significantly faster than the 60 deltas. And that's really what you're more concerned about. I'm not really concerned about gamma risk 1 year out. Gamma is not something that you really have to be concerned about that far out, but theta is. So the 30 deltas will decay much faster than the 60 deltas. There seems to be confirmation that Questrade does send tax forms. So for those of you that are concerned about Questrade, how much of a consideration is slippage or bid-ask spread? So bid-ask spread is the biggest concern for most options traders. Slippage, so I would say I don't know enough about the mechanics of slippage in Canada, so I would have to defer to someone else on that. This is something for those of you that are going to be coming to us during the Options Education Day. I highly recommend you to bring this up as a question during the Options Education Day because the people from the Montreal Exchange will be there and they can answer these questions, in my opinion, a little better than I can because I am here in the US and I only trade US equities. Thanks again, everyone, for the commission replies. I hope that helps everyone. For those of you that are concerned about commissions, and Francisco, same to you. I will see you in Montreal. Azim is saying, I meant, do you pick those with certain IV from your spreadsheet? So no, I do not. So I pick stocks that I own because if I don't own weed, I can't sell cover calls on weed. So this is really for, you shouldn't pick cover calls based on implied volatility. You should pick cover calls based on stocks that you own. For deep in the money, long dated calls to replace stock, what is the delta that you choose? More than 90%? No, I'd say 60 to 70% is usually a good delta for an in the money, long dated option to replace a stock position. Alan is saying, what is the cost of US options play? It's $50 a month or $500 a year. So with that, I think I'm at the end of the questions here. I've definitely taken a lot of your time here today. I really appreciate the wealth of questions that you guys have asked here today. I really hope that this has been useful for everyone to learn more about options trading and learn more about why you should add cover calls to your portfolio. And more importantly, I hope I showed you how OptionsPlay and the reports that we create make this as easy as possible for you. I know getting into cover calls and getting into options is not easy. It's not something that you'll be able to just watch one webinar and be able to instantly do, but that's why we're here every other week to do ongoing education for everyone, provide the tools, provide recordings of the education so that you can review over and over again until you get comfortable enough to do your first options trade. You know, we do the online webinars, we do the options education days. These are all free of charge, available to everyone so that you can learn more about this and feel comfortable. Ask your questions before you implement any of these strategies. The last thing we want you to do is to sell cover calls without having the right tools and without having your questions first answered. So I want to thank everyone for taking the time out here this afternoon. I hope you guys have a great afternoon. I'll see many of you in a couple of weeks on the Short Put webinar, and I'll see many of you in Montreal on June 1st. So thank you so much, and I hope you guys have a great evening.